Good afternoon everyone. Welcome to the official YouTube channel of Officers Center 24/7. My name is Amanjyot and today we are going to discuss some important questions with the concepts. Okay. So till now what we were doing, we were discussing only MCQs on your PPB subject on principles and practices of banking. So we were doing practices of 10 MCQs on daily basis at morning 7:30 a.m. Today what we are going to do, first of all, we are starting from the conceptual understanding, and at the end of the session we are going to discuss the MCQ on the same topic. Okay, so before starting the session, let me know, am I audible to all of you? And the screen is also visible. Are we good to go? Let me know, are we good to go? Okay, so everything is okay. Let's start with the session. Today we are going to discuss the very important topic related to the banking sector, that is monetary policy of Reserve Bank of India. So what we are going to do in this session, we are first going to understand the concepts related to the monetary policy and all the instruments related to the monetary policy. At end of the session, we are going to do the MCQs on the same. Okay. So before starting this session, first important thing, that is, if you have not subscribed yet the Officers Center 24/7 YouTube channel, then do subscribe the channel and press the bell icon so that you will get notified whenever the upcoming sessions are coming. And if you have not downloaded the 24/7 application, do download the application, because after downloading application you will get extra 1% discount on your products which you can buy from the 24/7 application. And apart from this, you will get the quiz for the practice of your banking terminologies or banking awareness. So if you have not downloaded yet, do download this application and subscribe the channel also. Now, one important information for all of you, that the English medium batch for your JAIIB June 2022 target batch is started already from 16th of April, and the classes of PPB will start from the 18th of April. It means from Monday, and it means tomorrow. So what you will get in this particular batch, what benefits you will get after enrolling this particular batch? First of all, this batch will cover the 3 books which is related to your all the 3 subjects of JAIIB. Apart from that, you will get the e-books which is also related to all the 3 subjects. In this you will have the concepts, and also as well as you will have all the MCQs related to all the concepts of your modules. Next, you will have 84 mock papers. Now mock papers are very important, because whenever we are talking about any exam, we want to qualify any exam, the important thing is how to implement our knowledge in the examination hall, in the exam. So what matters the most, that if you have the knowledge of a certain topic, if you have the knowledge of the certain concepts, but if you are capable, or if you are not capable of implementing that knowledge in the examination hall, then there will be no use how you will qualify the exam. So the mock papers, or we can say the practice, is very important to qualify any particular exam. So the mock paper will be also available, and recorded videos will be also available 24/7 in your account, in which you can watch whenever you will have time. Okay, if in any day you will be not able to join the live sessions of the faculty, you will get the recorded session, from where you can see the concepts, you can see the recorded session, and you can complete your particular topic. Okay, so this batch is started from 16th of April. Okay, the PPP class will start from tomorrow. The timing for our class will be 7:30 p.m. to 9 p.m. Okay, so let's start with the topic, that is monetary policy. So whenever we are talking about monetary policy, what actually monetary policy is? So first of all, the monetary policy is formulated by Reserve Bank of India. And what is Reserve Bank of India? It is the central bank of our country. So let's understand the base first. First of all, if we are talking about monetary policy, so who formulates the monetary policy? Reserve Bank of India, the central bank of our country, formulates the monetary policy. Now, why RBI formulates the monetary policy, or what additional work, or what is the actual working of Reserve Bank of India in our country? So RBI has 3 main objectives. That is, first, to regulate the banking system. RBI manages the banking system of our country. RBI regulates the banking system of our country with the help of RBI Act 1934, with the help of Banking Regulation Act 1949, with the help of Negotiable Instrument Act 1881. So RBI regulates the banking system. RBI decides that what functions a bank can perform. Now, how a bank can get licensed. Now, what the bank should do, that it will help the public, or it will be in the interest of the public. All these things will be decided by Reserve Bank of India, because RBI is the regulatory body of banking system. Now we are talking about financial system. Now what is financial system? Financial system means simply the system where we are exchanging funds. So when we are exchanging the funds, exchange of funds will comes under the financial system. So the financial system is also regulated by Reserve Bank of India. But when we are talking about financial system, there are two types of financial market, that is money market and capital market. So the money market is regulated by Reserve Bank of India under the financial system, and the last but not the least, the currency system is also maintained by Reserve Bank of India. Under the RBI Act 1934, Section 22, RBI has all the rights to print all denomination except rupee 1. Because 1 rupee note will be printed by your Ministry of Finance, Government of India, but 2 and above currencies will be printed by RBI. Has the sole right to print all these currencies in India. Okay. Now, so RBI has three major roles in our economy. In our economy, that is to regulate banking system, to manage banking system. Second, to regulate and manage the financial system, in which RBI, how RBI managing the financial system? With the help of money market and with the help of monetary policy, RBI managing the financial system. Because I have told you that financial system is the system where we are exchanging funds. There are certain persons who have surplus of money and there are certain persons who have deficit of money. So what we are doing, we are taking money from the surplus, from the persons who have surplus money, and we are providing that money in form of loan or advances to the persons who have deficit of money. Now what we are doing, we are exchanging funds between us. Okay, now this system is known as financial system. Now how RBI is managing this financial system? With the help of your money market and with the help of monetary policy, RBI makes sure that the currency, the money supply will circulate in the economy equally. All the persons, all the sectors who required money and all the sectors who have access money, they will deposit the money in the bank, and bank will provide, or bank will circulate that money to the persons who have deficit of money. Now this is the financial system. Sweetie, capital market is regulated by SEBI, not Reserve Bank of India. Okay, there are two type of financial market. First is money, second is capital market. But the capital market is regulated by SEBI, not by Reserve Bank of India. Do remember that. Okay. Now, between these session, if you have any doubt, related to the topic of, if you are not able to understand what I am delivering, so you can ask your question by commenting. Okay. And one important thing, before we move on, first of all, those candidates who are live in the session, do like the session and share the session with your colleagues who are also preparing for JAIIB exam. Okay, so let's start with the monetary policy. Now what is monetary policy? First of all, let's discuss what actually monetary policy is and why RBI makes monetary policy. What is the reason behind making monetary policy? So first of all, monetary policy is prepared by Reserve Bank of India, or we can say monetary policy is formulated by Reserve Bank of India. So RBI formulates monetary policy. Monetary policy is formulated by Reserve Bank of India. Now let me tell you that what is the objective of monetary policy. What is the objective of monetary policy? The objective behind making monetary policy is to maintain the price stability in the economy. The main objective behind making the monetary policy is to make sure that there is a price stability in the economy. But apart from this, RBI also have to ensure that whenever RBI is trying to maintain the price stability in the economy, RBI have to ensure that RBI is not harming the economic stability also. So with the help of RBI, we are making sure that there are economic stability in the economy and also the price stability. So RBI have to maintain price stability in the economy, but also RBI has to ensure that whenever RBI trying to reduce the prices, or whenever RBI trying to increase the prices, in that situation RBI have to make sure that this particular effects of monetary policy does not harm the economic stability of the economy. Now, how monetary policy will harm the economic stability? How is it possible? Because we know RBI is the central bank of our country, and RBI maintains the economic growth with Government of India. RBI maintains the money supply in the economy. RBI maintains the inflation in the economy. Now, how is it possible that whenever RBI making monetary policy, the economic stability will be harmed by Reserve Bank of India? Now, how is it possible? Let's take an example. First of all, let's take that in our economy there is deflation. Let's say in our economy there is deflation, or let's say there is inflation in our economy. Deflation is just the opposite of inflation, that is also known as negative inflation. Let's say we have seen that there is a high inflation in our economy. Let's say there is 15% inflation in our economy. That is known as your Galloping inflation. Now this inflation is the warning for the economy. If the inflation rate increases above 10%, now it becomes the warning stage for the economy that you have to control inflation, otherwise the economy will unstable. Now we have seen that there is inflation of 15%. It means the prices are rising. What is inflation? Inflation means rise in the prices. So we are saying prices are rising in the economy, and RBI is the sole authority. RBI is the regulatory body who has to maintain this inflation in the country, who has to maintain price stability in the country. Now what should RBI do to maintain these price stability? What should RBI do? RBI has to increase the policy rates under the monetary policy. RBI has to increase the policy rate under the monetary policy. Now what will happen if RBI increase the monetary policy rates? If monetary policy rates will be increased by Reserve Bank of India, it means the loans get costlier. The loans get costlier. And whenever the loans are costlier, in that situation, the public will remain with the less money supply. We will absorbing money from the market, or we are not giving the money to the public by increasing the policy rates. That means loans are getting costlier and public are not able to afford that amount of interest. Okay. So what we are saying that here the money supply will reduce. Whenever the money supply will reduce, the demand of goods will also reduce, and whenever the demand of goods will reduce, we can able to reduce the prices, because we know what is inflation. Whenever there is inflation in the economy, we see that first of all the money supply will increase. Whenever there is inflation in the economy, the money supply will increase, and as we see that there is increase in the money supply, let's say first understand the conditions of inflation. What are the conditions of inflation? Whenever there is inflation in the economy, the first step will happen that the money supply will increase in the economy. And when this money supply increases, that it means the public have more money to expend. Now the demand of public will increase. We are going to demand more goods and services to fulfill our needs. Now when the demands of public will increase, the supply will decrease automatically, because there is inverse relation between your demand and supply. There is inverse relation between the demand of supply. Whenever the demand will increase, the supply will decrease. So that's why there is increase in the prices. That's why we are seeing that the prices are increasing. So whenever we are seeing in inflation situation, the prices are increasing and demand is increasing. So what we have done, we have increased the policy rates, which has reduced the demand from the market, and it will reduce the prices from the market. But now this can affect negatively to the economy. How this can affect negatively to the economy? Let's say for example, we have reduce the money supply from the market. We have reduced the money supply from the market. Now what will happen? When we have reduced the money supply, the demand will reduce automatically. Now the public are demanding less goods and services. The expenditure capacity of public has been reduced. Now we do not have to increase our production. It means with the less demand, production will also decrease. Now when the production will decrease, the employment will also decrease. When employment decreases, the wages of persons will increase. Okay, now decrease. Now per capita income will decrease. The national income will decrease. Okay, this will be the situation in the economy whenever there is no demand in the economy. If I am saying production is decreasing, it means the GDP also decreasing, because first we have to produce, we were producing 100 goods. Now we are producing only 50 goods in the economy. It means when the production is decreasing, the GDP will also decrease. And when the GDP decreases, the economic growth will also decrease. Now when we are seeing that the economic growth is decreasing, it means we are facing the economic instability. So that's why we are saying that whenever RBI is making monetary policy, RBI have to make sure that the prices are stable in the economy, but also RBI have to make sure that while reducing the prices or while increasing the prices in the economy, RBI monetary policy does not harm the economic stability of the country. So the objective behind making monetary policy is to make sure price stability in the economy, and as well as to ensure the economic stability in the economy. Okay. Now, when did the review of monetary policy come? Now, let me know, till here is everything clear to all? Let me know whatever concept we have discussed till now. Is it clear to everyone? If is it clear, then do write the clear or okay or continue, so that we will move forward. So we have understand that what is the main objective of monetary policy behind making monetary policy, and how RBI maintain price stability and economic stability in the economy. Now next important thing is then when RBI maintains this monetary policy, when RBI formulates this monetary policy. So the monetary policy review by Reserve Bank of India is given in bi-monthly duration. So RBI gives bi-monthly review of monetary policy. Now what is bi-monthly? It means in every 2 months RBI can change the policy rates, RBI can change the monetary policy rates. Okay, so it means in every 2 months RBI has to check the money supply in the market, RBI have to check the liquidity in the market. If there is any inequality between the demand and supply, between the required money supply and available money supply, then RBI can change the policy rates. So the review of monetary policy comes bi-monthly in every 2 months. It means in one financial year, RBI gives 6 reviews of monetary policy. Okay. Now the financial year in which RBI gives the bi-monthly review policy, bi-monthly review of monetary policy is from 1st April to 31st March. Okay, let me know what is the financial year of Reserve Bank of India. Does anyone know what is the financial year of Reserve Bank of India? If you know, then do let me know in the comment section. So we have seen the financial year of monetary policy in which RBI gives the bi-monthly review is from 1st April to 31st March. Okay, from 1st April to 31st March. So we have seen bi-monthly review of monetary policy RBI is giving. In every 2 months RBI provide bi-monthly review or the review of monetary policy from the year 2013. Before Mr. Raghuram Rajan became the governor of RBI, Reserve Bank of India, the review of monetary policy used to come quarterly basis. It means earlier RBI used to give the monetary policy review on quarterly basis, but when Mr. Raghuram Rajan became the 23rd governor of Reserve Bank of India, it has changed its quarterly review to the bi-monthly review. So since 2013 we are using bi-monthly review, or we are providing, RBI is providing bi-monthly review of monetary policy. Okay. Now next. So this is the basic introduction of monetary policy, that what is monetary policy. When we are talking about monetary policy, how RBI is controlling money supply in the market. So first, RBI have certain instrument, that is direct and indirect instrument. Second, RBI also use the qualitative and quantitative measures. Okay, RBI use direct instruments, indirect instrument to maintain price stability and economic stability, and RBI use qualitative and quantitative measures to maintain the price and economic stability. So these are the instruments which RBI is using. Okay, now let's move forward and talk about actually what monetary policy is. So monetary policy is a macroeconomic policy. None has told me till now, none has told me that what is the financial year of Reserve Bank of India. I think you do not know, that's why you are not answering. The RBI used to make balance sheet of itself from the 1st July to 30th June. So the financial year of Reserve Bank of India is used to from 1st July to 30th of June, but now it has changed to 1st April to 31st of March. Okay, RBI has changed this financial year from the year 2020-21. As you know, RBI has given the annual report of banking ombudsman. So RBI has given the banking ombudsman annual report only for 9 months, because RBI has changed its financial year from 1st July to 30th June to 1st April to 31st March. It is also important to remember what is the financial year of RBI right now. Okay. Now, what is monetary policy? Monetary policy is a macroeconomic policy tool to influence. What monetary policy is influencing? It influences the interest rate, it influences the inflation rate, it influences the credit availability. It means with the help of monetary policy, RBI can change, RBI can influence the interest rate on which the banks are providing loan. Second, the inflation rate, whatever inflation in our country is going on. And third, the credit availability. It means the loan which we are providing in the market, the liquidity we are providing in the market. So RBI can influence with the monetary policy all these three. Now, through changes in supply of money available in the economy. Now, how RBI can influence all these three rates? By changing the supply of money in the economy. And how RBI will change the money supply in the economy? By increasing policy rates or by decreasing policy rates. As we know, bank rate, repo rate, CRR, SLR, all these are the instrument of monetary policy. So whenever RBI wants to increase money, whenever RBI wants that everybody should have money as much as they want, what RBI will do? RBI will reduce the policy rate. It will increase the money supply in the economy. Because it is obvious, when the loans are cheaper, more people are able to take the loan. So whenever the policy rates are decreased by Reserve Bank of India, there is increase in the money supply. But if we are saying that RBI wants to reduce the money supply from the market, RBI has to increase the policy rate, because by increasing policy rate, what will happen? The loans get costlier, and when the loans get costlier, public will remain with the less amount of money. Okay. Clear? So this is the basic monetary policy introduction, that what is monetary policy, what RBI is doing with the help of monetary policy, and how RBI is influencing interest rate, inflation rate, credit availability in the market by changing the money supply of the economy. Okay. The difference between bank rate and repo rate is that bank rate is for the long term period and repo rate is for the short term period. That's the difference between bank rate and repo rate. Okay, Bindu? Now in detail we are going to discuss further. Now next is monetary policy is formulated by RBI. Now it gives the bi-monthly review of monetary policy. It was recommended by Mr. Raghuram Rajan in 2013. He was the 23rd Governor of Reserve Bank of India. The financial year of Reserve Bank of India's monetary policy, or RBI's itself financial year, is now 1st April to 31st March, which used to from 1st July to 30th June. Okay. Now, what is the objective behind making monetary policy? To maintain the price stability and accelerate the growth rate of the economy. So we have to maintain the price stability, and RBI has to make sure by maintaining price stability economy is growing. Okay, you can't make sure ki what you are doing, you are reducing money supply in the market because you want to reduce the prices, but it will affect indirectly or it will affect negatively to the economy because the deflation will start growing. So what RBI have to maintain? RBI have to maintain the price stability, and RBI have to make sure that the growth of the economy is continuously running. Okay. Now, monetary policy is the process by which the monetary authority of our country, the monetary authority of our country is Reserve Bank of India, controls the money supply, often targeting an inflation rate, interest rate, to ensure the price stability, economic growth, availability of credit, and less unemployment. So these are the certain reasons because of which RBI is making monetary policy. So it is a process which helps the monetary authority of Reserve Bank or monetary authority of the country, or with this policy, monetary authority of country controls the money supply in the economy to maintain the stability in the economy. Okay. Now next is, what are the other goals of monetary policy? So first goal is to maintain the price stability. Second is to maintain GDP and economic growth. Third is increase national income. Fourth is creating employment and opportunities. Third, next is aapka trust in the currency system. Now let's take an example and we will discuss how RBI is following or how RBI is completing these goals with the help of monetary policy. Let's say we have seen that RBI has increased the policy rates. Okay, let's say RBI has increased the policy rates, or let's say RBI has decreased this policy rate. RBI has decreased the policy rate. Now what is the condition of the economy? Let's say there is deflation in the economy. Let's say there is deflation in the economy. What is deflation? Deflation is when the prices of goods and services are continuously decreasing, continuously reducing. Okay, that is your known as deflation. Deflation is also known as negative inflation. It is also known as negative inflation. Okay, right? So we have seen that the prices are reducing, prices are continuously falling because of the deflation in the economy. So RBI has to control this situation. RBI has to control this situation. RBI has to increase the prices in the economy. So to control this situation, what RBI has done, RBI has reduced the policy rates of monetary policy. Now as RBI has reduced the policy rates, now what will happen? The loans become cheaper. Okay. And the banks will have high liquidity, because whenever bank will taking loan from the RBI, the loans become cheaper. So bank will have the higher liquidity. When the bank will have higher liquidity, the loan availability of the market will increase. The loan availability in the market will increase. Okay, because there is higher liquidity with the banks. Now what will bank do with the higher liquidity? Bank will provide loan to the public, so the loan availability in the market will be increased, and the loan availability in the market increase with the less rate of interest. It means the lending rates of scheduled commercial banks will also reduce, because banks are getting loan from Reserve Bank of India at low rate of interest. That's why banks will provide loan to the public at the low rate of interest, because the policy rates are reduced by the Reserve Bank of India. So when we have seen that loan availability is more and the at low rate of interest, our banks are giving loan to the public. Now what will happen? The money supply with the public will increase, because loans are cheaper. Public will be able to take more loans. Loans will become cheaper. That's why they have more money. Whenever the public will have more money, the demand of public will increase. It is obvious. Whenever we have more money, we demand more goods. Okay, so whenever we are talking about that public are with more money, they will increase their demand. And when the demand will increases, okay, when the demand will increases, automatically the supply will decrease. When the demand increases, automatically the supply will decrease, because I have told you that there is inverse relation, there is negative relation between demand and supply. Okay, there is trade-off between demand and supply, there is negative relation between demand and supply, or we can say there is inverse relation between demand and supply. So whenever demand is increasing, supply will reduce. Whenever demand is reducing, supply will increase. Okay, these both will be opposite to each other. Now next thing is, we have seen that supply is less. Now what we have to do? Now we are seeing that the prices are increasing. Now we have seen the prices are increasing because there is more demand and there is less supply. So the situation of deflation we have reduced. Okay, so the first thing we have done correctly, that the goal of increasing price or maintaining price stability is fulfilled by Reserve Bank of India. Now how GDP, economic growth, national income will increase or decrease? Let's say, for example, we have seen that there is a demand in the market and the prices started increasing. Whenever there is demand in the market, we start producing more goods. So the production in the country will increase. The production in the country will increase. So whenever we are seeing that the production in the country is increasing, the GDP of country will increase. Now what is GDP? GDP is gross domestic product, simply the money value of all goods and services produced within the geographical boundary of a country. Whenever we are talking about GDP, GDP is the money value of all final goods and services which are produced within the country. So whenever we start producing more goods, our GDP will increase. Okay, and whenever the GDP will increase, economic growth will also increase. It means we have fulfilled these two targets also. We have increased the GDP, we have increased the economic growth. Now what will happen when the production will increase? Now when the production will increase, we have to hire more laborers. It means we will increase employment. What we will increase? We will increase employment. And when we are increasing employment, this employment will increase per capita income in the country, and this per capita income will increase the national income in the country. It means the national income will also be increased, and the employment opportunities was created by Reserve Bank of India because RBI has increased the money supply in the economy. Okay, now the last is trust in currency system. RBI maintains the trust in currency system of the public. Now how is it possible? Whenever RBI is maintaining price stability in the economy, there will be no money value will be reduced in the economy. Because money value, what is money value? The purchasing power of money. Whenever the prices are high in the economy, the money value will reduce, because at the same money we are getting less goods and services. So whenever there is high prices in the economy, the money value will reduce. But RBI is maintaining price stability, so that RBI maintaining is the money value of the currency, or we can say RBI is maintaining the purchasing power of the currency, or purchasing power of our money. Okay, it means our currency. So that's why when there is no decrease in the money value, when money value is not losing its value, then the trust of the public will remain in the currency system. So these are the certain goals which are fulfilled by Reserve Bank of India by making monetary policy. Okay, now let me know, clear till now? Is it clear till now? Yes or no? And those candidates who are live in the session, do like the session. And also share with your friends who are also preparing, colleagues who are also preparing for the same exam. Good afternoon, Debayan. Bank rate, repo rate, there is difference between bank rate and repo rate. Bank rate is for the long term period, Debashish, and repo rate is for the short term period. Okay, bank rate is long term and repo rate is short term. Both are similar. RBI is giving loan to commercial bank, but in bank rate for long term period and repo rate for the short term period. Okay, now let's move forward. These are the goals of monetary policy. Now let's discuss what actually monetary policy process is, how RBI is maintaining monetary policy, or how RBI is preparing monetary policy. So first of all, we have Monetary Policy Committee, which was introduced in the year of 2016. Monetary Policy Committee was formulated by central government, in which there are 6 members. We are going to discuss Monetary Policy Committee in detail further. So first is Monetary Policy Committee. Monetary Policy Committee's first meeting was held in 2016, and this Monetary Policy Committee decides, or this Monetary Policy Committee meets at least 4 times in a financial year to frame the monetary policy. Minimum, this is minimum. Okay, this is minimum 4 times, at least 4 times they have to meet. They have to meet Monetary Policy Committee. That is minimum, but maximum how much they are doing? They are doing for 6 times, because we have studied that the monetary policies review is given for the bi-monthly basis. Okay, so RBI is giving bi-monthly basis review of monetary policy. So at least 4 times the monetary policy committee has to meet in a financial year. But how much time they are meeting? They are meeting for the 6 times because they are providing right now the bi-monthly policy. Okay, earlier they were used to provide the quarterly review. That's why they were used to meet at least 4 times in a year. Clear? So first we have good afternoon, Amrita. So first we have Monetary Policy Committee. Second is Monetary Policy Department. Now Monetary Policy Department helps this committee to formulate the monetary policy. It is obvious not a single person can make monetary policy. Not a single person can decide that we want to increase the policy rate or we want to decrease the policy rates. So what we have to do? What we can do, what we have to do. So we have a certain department, we have a certain group of people who are the member of Monetary Policy Committee, and this department and these members are deciding after studying the economic condition of the country that what we have to do under the monetary policy. Okay, now next is Financial Market Committee. This Financial Market Committee meets daily basis to review the liquidity condition in the market. So the Financial Market Committee, what committee is doing, this committee is meeting daily, or this committee is analyzing daily on daily basis that what is the liquidity requirement in the country and what is the liquidity condition in the country. Whenever we are talking about the term liquidity, it means cash flow. We are talking about the cash flow. The committee who has given the Monetary Policy Committee functions, or who has suggested or recommended the functions, that committee is Chakravarti Committee, sweetie. Okay, we are going to discuss that further. Clear? Every doubt of yours will be clear at the end of the session. Don't worry about that. We will move forward term by term. Okay, step by step. Now this is the monetary policy process. It means the Monetary Policy Committee, the Monetary Policy Department, and the Financial Market Committee. All these three makes the monetary policy. Okay, now next thing is, when did Monetary Policy Committee came? So the first meeting of Monetary Policy Committee was held on October 3rd and 4th in 2016. Now it was constituted by central government. Do remember that the Monetary Policy Committee was not made by Reserve Bank of India. It was made by central government of our country. Okay. Now it is mentioned under the section 45 ZB of Amendment RBI Act 1934. So under RBI Act 1934 section 45 ZB, it has defined that what is Monetary Policy Committee and how it will help the RBI to maintain the monetary policy or to formulate the monetary policy. Okay. Now the next thing is, how many members are there? What is the function of Monetary Policy Committee? The function remains the same. What is the functions of monetary policy? To maintain the price stability, to maintain the economic stability, to increase the GDP, to increase the economic growth. These are the functions of monetary policy, and the similar functions will be performed by the Monetary Policy Committee because they both have the same targets. So the recommendation of functions of Monetary Policy Committee was given by Chakravarti Committee. Now what are the functions? To set the monetary policy norms related to economic growth, social justice, price stability, equity, encouraging growth for the new financial enterprises. Now these are the objectives. Apart from this, what are the different objectives of monetary policy? It tries to keep inflation rates under control. Now what is actually under control means that the target of inflation taken by Reserve Bank of India with consultation with Government of India right now is 4%. Right now it is 4%, and there is a ceiling of plus minus 2%. So this is the inflation rate according to Reserve Bank of India, which is known as under control inflation. Okay. Now when Government of India tries to accelerate the GDP, see, whenever Government of India is trying to accelerate the GDP, now how GDP will increase? GDP will increase only when the production of country will increase. Now when the production of country will increase only when the public is demanding more goods and services, when the demand of public will increase. So when the demand of public will increase, because when they have the more money supply, when public will have the more money supply. So it is obvious that the money supply will increase, the GDP will increase. But whenever the money supply will increase, there is a chances that the inflation will also increase. So whenever government is trying to increase the GDP, that's the duty of Reserve Bank of India, that's the duty of Monetary Policy Committee to control inflation rate, so that GDP will increase, but there is no high rate of inflation will be there in the economy. Okay. Section is 45 ZB of Amendment RBI Act 1934. Okay. Now next thing we are saying that the committee also decide the policy interest rate required to achieve the inflation target. Okay. So these are the functions or given by or recommended by the Chakravarti Committee for the Monetary Policy Committee. Now let's move forward and talk about who are the members of Monetary Policy Committee. So Monetary Policy Committee has 6 members. Out of these 6 members, 3 members will be appointed by Reserve Bank of India, and the next 3 members will be appointed by Government of India. The 3 members which are appointed by Government of India are known as Academicians. They are known as Academicians. The 3 members which are appointed by Reserve Bank of India, all these 3 members will be your ex officio member. Now, what does ex officio member means? Ex officio members means when you are deciding a certain person to work on a certain post by not seeing the qualification, by not seeing the experience, but you have decided that whatever person or whoever person will have a certain post will become the member of this committee also. Let's say, for example, Niti Aayog. We all have heard about the Niti Aayog. Will anyone tell me what is the full form of Niti Aayog? Do anyone know what is the full form of Niti? Now, whenever we are talking about Niti, what is the full form of Niti? You have to tell me. Do tell me in the comment section. Now, next thing is, in Niti Aayog, the chairman of Niti Aayog is Prime Minister. Now, this post is ex officio post. It means whoever person will become the Prime Minister of our country, that person will automatically become the chairman of the Niti Aayog. That's the same with the Reserve Bank of India. Whoever will become the governor of Reserve Bank of India will become the chairman of Monetary Policy Committee. So there are 6 members in the Monetary Policy Committee. 3 are appointed by RBI and 3 are appointed by Government of India. Okay. Now, the members who are appointed by Government of India are known as Academicians, and they will hold office for 4 years or until further orders given by Government of India, whichever result here. Okay, this is the duration for appointment of Academicians by Government of India. Now, these 6 members will decide that we have to increase the policy rate or we have to decrease the policy rate. Okay, that's their work. These six members will decide what to do with the monetary policy rates. Now, who are the right now members of Monetary Policy Committee? So, first is your governor. Always remember, the governor of Reserve Bank of India will be the chairperson of our committee, of our Monetary Policy Committee. And who is the right now governor of Monetary Policy? Sorry, who is the governor of RBI? Mr. Shaktikanta Das. So, Mr. Shaktikanta Das is the chairman of Monetary Policy Committee. Second is the deputy governor will be the second member. Deputy Governor of Reserve Bank of India. There can be 4 maximum deputy governor under the Reserve Bank of India. And when we are talking about deputy governor, Mr. Michael D. Patra, Mr. M. D. Patra right now is the member of Monetary Policy Committee. Now, the third member will be the one officer which will be nominated by the Central Board of Reserve Bank of India. Now, there are 21 members in the Central Board of Reserve Bank of India. These 21 members will decide who will be the third person of Monetary Policy Committee. Okay, so there will be 3 persons appointed by Reserve Bank of India under the Monetary Policy Committee. One will be governor, second will be deputy governor, and third will be one officer which will be nominated by the Central Board of Reserve Bank of India. Okay. Now, if we are talking about right now, Mr. Mridul K. Sagar is the third member of Monetary Policy Committee appointed by Reserve Bank of India. Now, when we are talking about academicians, it means the members appointed by Government of India. There are 3 members. First is Miss Ashmiya Goyal. Second is Mr. Jayantar Verma, and third is Mr. Shashank Kabite. These are the 3 members which were appointed by Government of India for the Monetary Policy Committee. Okay. Now, let's move forward. और देखते हैं what are the different types of monetary policy, classifications of monetary policy. When we are talking about classification of monetary policy has 2 types. It is first expansionary monetary policy, that is also known as easy monetary policy, and second is your contractionary monetary policy, that is also known as tight monetary policy. Let's understand one by one what actually these types of monetary policy means and how they are affecting the economy or how they are impacting the economy. First of all, when we are talking about easy monetary policy, what does means of easy? Easy means you will have the money easily. So whenever we are talking about easy, it means it is very normal to have something. It is very easy to have something. It is very easy to earn something. Easy means you are able to do so. So whenever we are talking about easy monetary policy, or we can say the expansionary monetary policy, in this policy, RBI wants to increase the money supply in the market. So what RBI should do? RBI will reduce the policy rate, which will make it easy to public to have more money supply. So in the expansionary monetary policy, RBI is trying to expand the economy. What RBI trying to do? RBI is trying to expand the economy. RBI wants to expand the economy. Now, how economy will expand? How public will have more money? When RBI will reduce the policy rates, RBI will have RBI will give the higher amount of money or the more volume of money in the market. So expansionary monetary policy helps RBI to expand the economy, or we can say easy monetary policy is the policy by which public will have money supply with them, more money supply with them easily. And when will public have more money supply easily? When the policy, lending rates will be low. It means loans are cheaper. Now, just the opposite of this easy monetary policy, we have contractionary monetary policy or tight monetary policy. In expansionary monetary policy, we are trying to expand the economy. Okay. But in contractionary monetary policy, we are trying to contract the economy. It means we are trying to decline the economy. We are trying to make sure that the economy is declining. Okay. That is known as contractionary. Now, it doesn't mean that we want that there will be recession in the country. It doesn't mean we want deflation in the country by purpose. No. But whenever there is high inflation, high inflation affects the economy. So to control that high inflation, we make the tight monetary policy which helps us to decline the money supply from the market. Okay. So in this particular policy, RBI will increase the policy rates and that will reduce your money supply from the market. And when the money supply will be reduced by Reserve Bank of India, it automatically reduces the inflation in the economy. Okay. Now, let's discuss the definition of these two policies. First is expansionary monetary policy. The definition is, under this policy, RBI aims at encouraging. Do focus on the keywords. Now, what RBI want to do with the help of easy monetary policy? Do focus on the keywords. Under this policy, RBI aims at encouraging spending by public. It means RBI wants that public will expend more on goods and services. It means RBI wants to increase the expenditure capacity of the public. Now, when the expenditure capacity of us will increase, whenever we have more money. So, RBI want to encourage spending on goods and services by lowering the policy rates. It is obvious, whenever RBI will reduce the policy rate, there will be more money in the economy. When the more money will be available with the public, their demand will increase. Okay. So RBI will lower the policy rate, which will encourage the public to increase spending. And the next thing is it will expand the credit supply in the market. It means it will increase the money supply in the market. Now this is known as expansionary monetary policy, in which RBI has lowered the policy rates, which increase the expenditure capacity of the public, because the public will be more with more money supply. Okay. Now this is your expansionary monetary policy, or we can say easy monetary policy. Now, what will be the impact of this policy on the economy when we are talking about that RBI is making easy monetary policy? So we have seen that RBI has reduced the policy rates. Now, do understand each and everything carefully. Do listen carefully, because all these are the impact on the economy whenever RBI is making easy monetary policy. Now, RBI has reduced the policy rates from the market. Okay. What will happen? Now, the banks will have more liquidity. Now, banks will remain with the more liquidity. More liquidity means banks will have more money. So, whenever RBI is reducing policy rates, banks will have more liquidity in the market with themselves. Bank will have more liquidity with themselves. Now, this more liquidity will affect the available loan in the market. The loan availability will be increased in the market, because banks are having more liquidity. What will bank do with the more liquidity? Bank have to lend that money. So loan availability will increase, and the lending rates, the rates at which banks is giving loan to the public will be reduced, because RBI has reduced the policy rates. So lending rates will be less and the loan availability is more. It means it became easy for the public to take loan. It means that the money supply will increase. Money supply will increase because it become easy to take loan. Now, when the money supply will increase, the demand of public will also increase, because we are having more money, so we will spend more money. So demand will increase. But the relation between demand and supply is opposite, is inverse relation, so supply will decrease. The supply of what? Supply of not money, supply of goods and services will decrease. Okay? The supply of goods and services will decrease. Now, whenever the supply of goods and services are decreasing, what will be the next impact? What will be the next impact here? Let's say demand is more than the supply, so the prices will increase. So the prices will increase. It means easy monetary policy creates the condition in the economy where the inflation can become high. Okay, with the help of easy monetary policy, RBI can increase inflation in the economy. Clear? So prices are rising because the public have more money, they have more demand, but they do not have supply in the economy. So prices will increase. Now what will happen next? We have seen that public have a demand and we do not have sufficient goods to supply. So what we have to do? We have to increase the production. Here the production will increase. So whenever the production will increase, the GDP will increase, gross domestic product. Whenever the GDP will increase, economic growth will also increase. Now, whenever we are increasing production, this production will increase the employment in the economy. Okay. Whenever the employment will increase, the per capita income will increase. What is per capita income? The average income of an individual. What is per capita income? The average income of an individual is known as per capita income. Now, when the per capita income increases, national income will also increase. Okay, now these are the effects which we are seeing in the economy when RBI is making easy monetary policy. Do you understand all these things? So these are the impact which are happening in the economy whenever RBI is making easy monetary policy. Now because our economic growth is increasing, public have more money, public have employment, so they will be literate in the economy, they will have more money, they will increase their living standard. Okay, they will become literate, we will have a certain infrastructure facility, we will have all the basic facilities. Now after seeing all these things, at the end of the time, economic development will happen in the economy, because when you want to develop the economy, you have to give money supply to the public. Without developing human resource in the economy, it is not possible that you will be able to increase the development of the country, to increase the living standard of the public. Okay, so the easy monetary policy helps economy in this way. Now let me know, till now clear to everyone? Answer quickly. We have discussed the impact of easy monetary policy in the economy. Is it clear to everyone? Or if you have any doubt related to today's session till now which we have covered, if you have any doubt, then ask, because we are going to practice the MCQs. Okay, we are going to practice the MCQs, so we need the understanding of the concepts so that we will be able to answer the questions. Is it clear to all? Now what is next? Next is our second type of monetary policy, that is your contractionary monetary policy. Okay, now before moving forward to the contractionary monetary policy, those candidates who are live in the session, do like the session. Okay, now let's move forward. Second is your contractionary monetary policy. Contractionary monetary policy, RBI wants to decrease the spending capacity of public. RBI wants that public are not able to spend more. The RBI wants to reduce the expenditure capacity of public, the expenditure capacity of the consumer. Now, whenever RBI want to reduce the expenditure capacity of the public, RBI have to increase the policy rates. Whenever RBI will increase the policy rate, the public will have the less credit supply in the market. It means the public will have less amount of loan or the less volume in the money supply, volume of money supply in the market. Okay, so credit supply will decrease in the market. So that will be known as your contractionary monetary policy or tight monetary policy, which reduce the money supply in the market. Okay, and now what will be the impact of your tight monetary policy in the economy? We are not going to discuss this. This is your homework. Now this is your homework that you have to discuss. You have to make sure that how we have discussed the impact of easy monetary policy, you have to do it by yourself, that what will be the impact of tight monetary policy on what will be the impact of tight monetary policy on the prices. Second, what will be the impact of the tight monetary policy on GDP, on economic growth, on economic development, on national income or per capita income. Now this is all your task which you have to do, that what will be the impact of the tight monetary policy on all these economic indicators. What are these? These are economic indicators. So this is your task that you have to do it as a homework. Okay, now let's move forward and discuss what are the different instruments of monetary policy. So monetary policy have two types of instrument, that is direct and indirect. First we are talking about direct instrument. Now what is direct instrument? Direct instrument have three instruments, that is known as CRR. First is CRR, that is cash reserve ratio. Second is SLR, that is statutory liquidity ratio. And third is your refinance facility. So these are the three instruments of direct instrument. Okay. Now, if we are talking about indirect instrument, we have bank rate, we have repo rate, then we have reverse repo rate, then we have liquidity adjustment facility. The full form of all are also important. Okay. Now, next is your market stabilization scheme. Then we have open market operation. Then we have marginal standing facility. Now, these are the direct and indirect instruments related to your monetary policy, with the help of which Reserve Bank of India maintaining, or Reserve Bank of India controlling inflation in the economy. Okay. Clear? So these are the types of instrument, or these are the instrument of monetary policy. Now, apart from these, what are the different methods with the help of which RBI maintains money supply? First is your direct instrument, second is your indirect instrument. Apart from this, RBI also have qualitative credit control measures, or we can say only qualitative measures. Qualitative measures are also known as selective credit control measures. Selective credit control measures. So apart from direct and indirect instrument, RBI has qualitative measures and RBI has quantitative measures. Quantitative measures. Okay. Now, when we are talking about quantitative measures, what is quantitative measures? These are also known as general credit control. General credit control measures. Okay. These are the two types of measures which RBI use to maintain money supply in the economy. Now, what is qualitative measures and what is quantitative measures? First of all, let's understand the basic difference between these two. So, whenever we are talking about qualitative measures, it's focused on the value of credit. It tells us where to use of credit. It tells us the quality use of credit. It tells us about the quality use of credit. It means in selective credit control, what RBI is doing, RBI letting us know that in which, letting us means the commercial banks. In qualitative measures, RBI is letting know the commercial bank that in which sector it is important to give loan, in which sector you should provide loan, in which sector how much amount of loan you should give, in which sector what will be your margin requirement, in which sector what will be your down payments regulations or down payments policies. So all these are related to your qualitative measures in which RBI is telling you about the value of credit you are providing in the market, the quality of credit you should provide in the market. It means RBI gives certain norms or certain restrictions or certain regulations under the qualitative measures in which RBI tells us that in which sector you have to provide loan, how much loan you should provide, and of what quality loan you should provide. Let's say, for example, there is inflation in the economy. The prices of all the goods and services are rising. But apart from automobile sector, now automobile sector is facing deflation and all the other sectors are facing inflation. Now this situation first of all is known as skewflation. When there is inflation and deflation both are present in the economy, that situation will be known as skewflation. SKEWFLATION. That is known as skewflation. So we have seen that all the sectors are having inflation in that sector. It means the prices are increasing, but deflation is but in automobile sector we are seeing deflation in the economy. Now there is a situation where there are certain sectors which are facing inflation and there is one sector which is facing deflation. Now in that situation, what quality of credit will means, RBI will give guidelines to the commercial banks that you have to provide loan, but do not provide loan to the unnecessary sector. Provide loan to the automobile sector because the growth of the automobile sector is declining. Because the growth of the automobile sector is declining, and because of that the economic growth is also declining, the earning of government is also declining. Okay, the demand of goods will also decreasing in the automobile sector. So RBI has said that you do not have to give loan to the unnecessary sectors where there is already inflation. So what you have to do, you have to provide loan to the sector which is facing deflation, that is your automobile. Okay, so this is the qualitative measures under which RBI is telling us where to use funds or where not to use. Us means the commercial bank, not us, you and me. Us means the commercial bank. Now next is quantitative measures. Quantitative measures tells us about the volume of credit. It tells us about the volume of credit, like how much amount of loan you should give. How much amount, not telling where to give loan, where not to give loan. RBI is telling volume of loan. It means volume of credit. There we will, in qualitative measures, we were controlling the value of credit. But when we are talking about quantitative measure, we are talking about volume of credit. It means how much money supply you should give in the market. It means how much volume of money should be available in the market. That is known as your quantitative measure. Okay. So quantity, it means you are deciding the quantity of money should be available in the market. And when we are talking about qualitative measures, you are deciding the use of credit, in which sector you should use your money. That is qualitative. Okay. Now direct instruments are three, that is CRR, SLR and refinance facility. When we are talking about direct instrument, these are the instruments which are affecting all the banking system. It means whenever there is change in CRR, all the banking system have to maintain that change. If there is a change in the SLR, all the banking sector has to maintain that change. But when it comes to indirect instrument, we can use these instruments certainly as per the requirement of the market. Let's say if we are seeing that the commercial banks are having more money, so what will we do? We will sell the government securities. And we are seeing that the commercial bank are facing the liquidity requirement problems. It means they do not have sufficient cash to perform their day-to-day transactions also. In that situation, what we will do, we will purchase the government securities, or we will give loan to the we will give loan to the commercial bank with the help of bank rate and repo rate. Okay, so these are the certain instruments which are of monetary policy, and with the help of which RBI is maintaining price stability and also maintaining economic stability in the country. Okay. Now let me know, this is the overall concept. We have discussed the basics of your monetary policy. Now in the further sessions, we are going to discuss these instruments, which is direct and indirect, and also the qualitative and quantitative measures. Okay. Now let's practice certain questions on the monetary policy. With the help of these questions, we will understand the different concepts or different instruments of monetary policy. Now each and every person who is live in the session, they have to answer in the session. And let me check that how much understanding of the topic you will have. Okay, after discussing all the monetary policy basics, what understanding you get from this particular session. So for this clarity, you have to answer your questions. Okay, the first question is, if RBI wants to reduce liquidity from the system, it should. Do count how much answers you are giving right. Okay. First of all, you have to answer about all the questions and do write question number with your answer. Second thing, do count how many answers you have given correctly. So the first question is asking, if RBI wants to reduce liquidity from the system, it should. What should RBI do? RBI should decrease the reverse repo rate, RBI should decrease the repo rate, RBI should increase the CRR, or RBI should decrease the SLR. Now, what should be the step taken by Reserve Bank of India to reduce the liquidity from the market? Let me know. Parul is saying C. Okay, what about rest? Okay, Priyanka is also saying C. Rajesh is saying, Bindu is saying C. Okay, very good. Everyone is going with the C option. That is right. Let's understand the keywords of the question. Question is asking that RBI wants to reduce the liquidity from the system. RBI wants to reduce liquidity. Now, when will the liquidity will reduce? When RBI will increase the policy rate. So the increase option is only C option. So the right answer will be your C option. Very good. Everyone is giving the right option. Very good. The right answer will be your C option. That is increase in CRR. Next question. Next question is asking that which of the following bank will not be making any money? In which of the following bank will not be making any money? Now, by doing these questions, we will understand more concepts related to monetary policy also. Okay. So don't worry if you do not know the answer of any question. In every question, we are going to discuss additional information related to the monetary policy. So here we are asking, in which of the following bank will not be making any money? It means bank will not be making any, bank will not be earning. Okay. So first option is saying meeting CRR requirement. Second is saying meeting SLR requirement. Third is saying parking money with Reserve Bank of India under reverse repo. Now what will be the answer of the question number second? Do write the question number while you are answering the question. Is it A, B, C or D? Again, a very simple question. If you have earlier studied about CRR, SLR, reverse repo rate, then you can answer easily. That's a very simple question. But again, each and every question is important because the conceptual understanding is clear by these questions. So all the questions in your paper will be conceptual based questions. So you have to be able to know what are the concepts between the topic, behind the topic. Parul is saying A. Bindu is saying A. Bhagirath is also saying A. Suri is saying A. Rajesh is saying A. Okay. First of all, let's understand this. Let's understand the concept. Okay. Then we will see what will be the right answer. Let's understand the concept first. Here they are asking that in which of the following banks are not making any money. If I am talking about reverse repo rate, you are saying the A option. If I am talking about reverse repo rate, what is the current reverse repo rate? That is 3.35%. Now this 3.35% is paid by Reserve Bank of India to commercial banks. Who is paying this? It is paid by Reserve Bank of India right now to commercial bank. Why RBI paying this interest to the commercial bank? Because in reverse repo rate, commercial banks deposit their surplus money with RBI. It means on reverse repo rate, commercial banks are earning money. Commercial bank right now earning 3.35% interest while they are maintaining deposit, or while they are depositing their surplus money with Reserve Bank of India. They are earning 3.35%. It can't be the right answer because in reverse repo rate, banks are earning money. Banks are depositing their surplus money with the Reserve Bank of India, and RBI is providing the certain rate of interest to the banks. So the third option will not be the right answer. When it comes to SLR, what is SLR? Let's understand what is it. This is your reverse repo rate. This is your reverse repo rate. Now, what is SLR? Let's understand here. Under the statutory liquidity ratio, all the scheduled commercial bank, okay, have to maintain. All the scheduled commercial bank have to maintain a certain reserve as their percentage of NDTL, which will be given by Reserve Bank of India. The percentage of NDTL will be specified by Reserve Bank of India in the form of cash, in the form of gold, and in the form of securities. Okay. So in SLR, all the scheduled commercial banks have to maintain reserve with themselves, not with Reserve Bank of India, but with themselves. Okay, with themselves. So here we are seeing that in SLR, scheduled commercial banks have to maintain a certain reserve of their NDTL percentage, which will be specified by Reserve Bank of India on bi-monthly basis with themselves in form of cash, gold and security. Now let me know, if I am talking about securities, which security is it? This is government securities. And on government securities, every time whoever person is investing on government security, that person is earning a certain rate of interest. Every government security has a certain maturity period for 1 year, 2 year, 3 year, 5 year, 91 days. Every government security has a certain maturity period with itself. And as soon as that maturity period ends, you will get your principal amount with a certain interest rate. It means banks are able to earn on SLR also, on the securities they are maintaining with themselves. It means second can't be the right option. Now we are left with the first option, that is CRR. Now what is CRR? CRR stands for cash reserve ratio. Under this cash reserve ratio, all scheduled commercial banks have to maintain a reserve as the percentage of their NDTL, which will be specified by RBI on bi-monthly basis in form of cash with the Reserve Bank of India, and at which no interest will be paid by Reserve Bank of India to commercial bank. It means on CRR, RBI do not pay any kind of interest to the commercial banks. That's why banks are not earning any kind of money on CRR. RBI has paid interest rate to the CRR to commercial bank only at the time of banking slowdown of 1999. So RBI has paid interest on CRR to commercial bank once till now, that is the banking slowdown period of 1999. After that, RBI has not paid any interest to the commercial bank. So it means the right option for this question will be your C option, that is only one. Clear? The concept related to this question is clear to all. Now, to learn these types of conceptual understanding, we have already started a batch that started from 16th of April. So the PPB classes, it means the principles and practices of banking classes will start in that particular batch from tomorrow onwards. It means from Monday onwards. So to learn this type of conceptual understanding, or to make sure that whenever you are attempting mock test or you are going for your exam, main exam, you will be able to understand the concepts, or you will be able to implement that concept in the question. That is very important. So to know or to learn these types of concepts, do join the batch which is started from the 16th of April. Okay. Now next is, if RBI wants to inject more liquidity in the system, it should. Now RBI want to inject liquidity. It means RBI want to increase liquidity in the market. What should RBI do? RBI should increase the CRR rate, it should increase the SLR rate, it should increase the bank rate, or it should decrease the repo rate. What will be the right answer? A, B, C or D? Do write the question number also while answering. Parul is saying D. Okay. What about rest? Vinod is also saying D. Rajesh is saying D. Priyanka is also saying D. Very good. The right answer for this question is your D, that is decrease the repo rate. Right answer is D, that is decrease the repo rate. Very good. Now next. Which of the following statement is not correct about Monetary Policy Committee? You have to answer that which of the following statement is not correct about Monetary Policy Committee. First statement is saying it comprises of 6 members where Governor of RBI acts as ex officio chairman. One second. Now answer the question. Do write the question again. Do write the question again and then answer. The question is asking which of the following statement is correct. It's not asking incorrect, it's asking correct. Now answer the question, okay? Now again read the question. First is saying which of the following statement is correct about Monetary Policy Committee. First saying it has 6 members where Governor of RBI will become your ex officio chairman. Now second is saying it was created to bring transparency and accountability in deciding monetary policy rates. Third is saying inflation target is set by Reserve Bank of India in consultation with Government of India. Now choose the correct option. Correct, you have to tell the correct, not the incorrect, okay? I have edited the question. Now let me know what will be the right answer. Which of the following statement is correct? A, B, C or D? Parul is saying A, Vinod is saying D, Priyanka is saying D. What about rest? Very good. Everyone is going with the D option. That is true. All are true because all are related to the Monetary Policy Committee. That is true. Very good. The right answer will be your D. Now next. An open market operation. Question is asking. An open market operation is an instrument of monetary policy which involves buying or selling of dash from or to the public and banks. Is it bonds and other local security? Is it debentures and shares? Is it government securities, or is it none of the above? Now what will be the answer of your question number 5th? A, B, C or D? Vinod is saying C. Okay, that is government securities. Again, a very simple question. See, each and every question only required the conceptual understanding of yours, okay? Now what will be the right answer? Okay, everyone is going with the C option. So let's go with the C option, that is your government securities. That is correct. Next. Sixth question is asking about the cash reserve ratio is an effective instrument of credit control under the Reserve Bank of India Act 1934. Every dash bank has to keep certain minimum cash reserve with Reserve Bank of India. Now what will be the answer of your question number 6? Is it public bank? Is it commercial bank? Is it industrial and agriculture bank, or is it none of these? What will be the answer of the sixth question? Okay, everyone is going with the B option, that is true. Scheduled commercial bank. Every scheduled commercial bank have to maintain a certain percentage of their NDTL with Reserve Bank of India in form of cash, and the percentage of NDTL will be specified by Reserve Bank of India on bi-monthly basis. Okay, which is right now is 4%. Cash reserve ratio right now is 4%. Achha, let's discuss all the rates right now. First of all, CRR is right now 4%. SLR is right now 18%. Your bank rate is right now 4.25%. Your repo rate is right now 4%. Your reverse repo rate is right now 3.35%. Your marginal standing facility right now is 4.25%. Now these are the current policy rates and reserve ratios which is decided by Reserve Bank of India in the first review of monetary policy for the financial year 2022-23, which was given by Reserve Bank of India in month of April. Okay, now in the first week of April. Okay, now let's move forward to the seventh question. The question is asking, one second, the question is asking which out of the following is the correct regarding cash reserve ratio. You have to tell the correct option. You have to select the correct option. First option is saying Section 42(1) of RBI Act 1934 lays foundation of maintaining CRR by scheduled commercial bank with RBI. Section 42(1) of RBI Act 1934 lays foundation of maintaining CRR. Second is saying Section 24 of Banking Regulation Act provides power to RBI to levy CRR on banks. C option is saying banks cannot earn profit on CRR. What will be the right answer? What will be the right answer? Is it A, B, C or D? Do write the question number also, okay? Bhagirath is saying A, that is only A and C, okay? What about rest? Seventh is A, that's a guessing, okay. Priyanka is saying A, Suresh is saying A, Rajesh is saying A. Okay, everyone is going with the A option. Very good. C. First of all, CRR is defined under Section 42(1) of RBI Act 1934, and under Section 24, it has defined the SLR. SLR is defined under the Banking Regulation Act 1949, Section 24. And we have already discussed this C option in the first question, that banks cannot earn profit on CRR. The right option will be your A and C. Only A and C will be the right option for your question number 7. And SLR is defined under the Section 24 of Banking Regulation Act 1949. Okay. Now let's move forward to the next question. Next question is asking, which among the following defines the marginal standing facility rate? Which of the following defines the MSF rate? The first option is saying the rate at which banks place their surplus fund with Reserve Bank of India. Second option is saying the rate at which Reserve Bank is prepared to buy or rediscount bills of exchange or commercial papers eligible for purchase. Next option is saying the rate at which banks can borrow against their excess SLR securities to meet additional liquidity requirements. D option is saying the rate at which banks borrow funds from Reserve Bank against eligible collateral. Now, what will be the right answer for this 8th question? Is it A, B, C or D? We are talking about MSF. Now, what is MSF? Let me tell you. First of all, marginal standing facility is an indirect instrument of monetary policy. Whenever we are talking about marginal standing facility, it was launched in the year 2011. And in 2013, RBI has linked this marginal standing facility with bank rate. That's why whatever changes will be done by Reserve Bank of India in bank rate will be implemented on the MSF. Now, in the marginal standing facility, RBI gives loan to the commercial bank only for overnight duration. It means only for 24 hours. The funds or the loan which RBI is giving to commercial banks under marginal standing facility comes from the SLR portfolio. It comes from the SLR portfolio. So very good. The right answer will be your C option, because we are talking about SLR securities. Just you have to focus on the keywords related to your concepts. So in MSF, RBI gave loan to the commercial bank for overnight duration for 24 hours only, and that loan comes from the SLR portfolio. So the right answer will be your C option. Very good. Next. In context of Indian economy, open market operation refers to. In context of Indian economy, open market operation refers to which of the following option? First is saying borrowing by scheduled banks from RBI. Second is saying purchase and sale of government securities by RBI. Third is saying lending by commercial bank to industry and trade. Or fourth is saying none of the above. What will be the right answer for the 9th question? A, B, C or D? Bindu is saying B, Venkat is saying B, Suri is saying B, Rajesh is saying B. It's very good. True. That is purchase and sale of government securities by RBI. So open market operation is an indirect instrument of monetary policy in which RBI sells and purchases government securities to or from commercial bank to maintain the liquidity of commercial bank. Okay. So in open market operation, public can't directly participate. Public can't participate directly in the open market operation. In marginal standing facility, in market establishment scheme, public directly can participate in the selling and purchasing of government securities. But in open market operation, public cannot directly participate in the selling and purchasing of government security. That's the difference between open market operation and MSS. Okay. Now the next question is asking about when RBI reduces SLR, which of the following is likely to happen? When RBI reduces SLR, which of the following is likely to happen? Now what is SLR? We have discussed the statutory liquidity ratio, in which all the scheduled commercial banks have to maintain a certain percentage of their NDTL with themselves in form of cash, gold and security. So what will be the right answer for the question number 10? A, B, C or D? India's GDP growth rate increased drastically. Second is saying foreign institution investment may bring more capital into our country. Third is saying scheduled commercial banks may cut their lending rates. Fourth is saying it may drastically reduce the liquidity to the banking system. What will be the right answer for the question number 10th? Parul is saying C. Okay, what about rest? Bhagirath is saying D. Okay. Bindu is saying A. Priyanka is saying C. Vinod is saying A. Okay. Acha, tell me how the D option will be correct. If RBI is reducing SLR, here we are saying that RBI is reducing SLR. It means RBI is making easy monetary policy. Or if RBI is making an easy monetary policy, the money supply will always increase, because in this policy, RBI is reducing policy rates. So the D option cannot be the right option, beta, because it may drastically reduce liquidity. No, when RBI is reducing SLR, it will increase liquidity in the banking system. Okay, so D can't be the right answer. If we are talking about A, if RBI is reducing SLR, it directly increases the GDP growth of India. How is it possible? Directly, as Reserve Bank of India reduced the SLR rate, it will drastically increase the GDP of India. No, it will not be possible. There will be no drastic increase in the GDP growth rate. Now, foreign institutional investment may bring more capital in the economy. No, it will happen when the government reduces the taxes and duties, or government will provide relaxation on the taxes and duties. Then this will happen. Or when SEBI liberalize the norms related to foreign institutional investors, then it will increase. They will increase capital in the country. They will invest more in the country. The right answer will be your C, that whenever RBI reduces SLR, what will happen? What is SLR? Do try to link the concept with the question. We are asking about SLR. Now, what is SLR? SLR is the statutory liquidity ratio in which scheduled commercial banks have to maintain with themselves in form of cash, gold and security a certain percentage of their NDTL. When RBI is reducing SLR, it means banks have to maintain less reserves. When banks have to maintain less reserves, what will happen? Banks will cut their lending rate because bank will have more liquidity, then bank will provide more loans to the public, so they will decrease their lending rates. The right option will be your C option. The concept is clear to all? Is the concept clear to all? Bilkul. Correct parole, the liquidity will increase whenever we are reducing the SLR or CRR or bank rate or repo rate. Any monetary policy rates reduced by Reserve Bank of India, it will increase the liquidity. Or any monetary policy rate increased by Reserve Bank of India, that will reduce the liquidity. Okay, understand the concept. When you know the concept, you will answer the right option. Okay, now let me know, out of 10 questions, how much you have done correct. Or if you have any doubt related to today's session, let me know. Now, one information for all of you, that is the batch. I have already told you that the batch started from 16th of April. The classes of PPB will start from 18th of April. It means from Monday. Clear? And this batch will have 3 Macmillan books with itself. And ebooks will be also available there. Mock papers will be also available there. Recorded videos will be available there. Now, what I am going to teach in this particular batch, now what we are going to discuss in this particular batch is, first we know that we have a lot more syllabus of PPB. We have 5 modules, A, B, C, D and E. So there are a lot of topics. There are a lot of schedule. There is a vast schedule of PPB. So how to cover this particular syllabus? What we are going to do, we will cover each and every topic, but we are going to focus on the certain specific topics which are which will be helpful for all of you to gain more marks from in the exam. So first of all, we are going to understand all the terms related to your syllabus, which is given in the study plan also. Do check the study plan when you start this particular batch. In that study plan, which I have given certain topics, how we are going to cover the syllabus of PPB. So do check that particular study plan. And first we are going to do the conceptual understanding in the sessions, in the paid classes. And after doing conceptual understanding, we are going to practice some previous year questions on the topic, and we are going to practice some MCQs on the topic, so that you will know how to implement that knowledge on the MCQ. Okay, or how to implement that knowledge in your main exam. So the practice is must. That's why we are including mock papers. That's why in the live sessions we are going to practice the previous year questions as well as the new questions for particular topic. Okay, so this is batch started from 16th of April. PPB class will start from tomorrow, that is Monday. And to enroll in this particular batch, you can use a code, that is Y496. By using this code, you will get 78% discount on Adda 24/7 application. You have to visit the application or you have to visit the website and you can purchase this particular batch. You will get the 3 Macmillan book with it. Now, how to read these books in a lesser period of time. So for this, we are here. We will guide you, all of you, that how you can cover the book and what is important to cover with this Macmillan book. Okay. So that's all for today. We have discussed the monetary policy conceptual understanding and we have done certain MCQs on monetary policy. So thank you all for joining the session. And last but not the least, if you are new to the session, do subscribe the session and press the bell icon, so that whenever the upcoming sessions we are scheduling in the particular channel of Adda 24/7 officers Adda 24/7, so you will get notified about that particular session. Okay, so thank you all for joining the session and stay safe.